Okay, so let's begin with this fifth reading. It's fairly simple, and I'll go through my notes first. I'll link it down in the comments, and you can save it from there. Okay, cross again. Okay, so let's begin with this fifth reading, modern portfolio theory and capital asset pricing model. So it's fairly important, but I'll simplify it down as much as possible. I'll go through my notes first. I'll add the link to my notes in the comments again, and you can go through it at your pace later. And then after that, we'll see the book. So let's see my notes first, modern portfolio theory and CAPM. The first thing that I've written here is that the return of the portfolio would be the summation of the weight you assigned to that stock multiplied by the return generated from that stock divided by the sum of the return. So let's simplify this down. You invested $50 in one asset that earned, let's say, 10%, and you invested another $50 in an asset that returned 15%. So your average portfolio return would be 50 into 10% plus 50 into 15% divided by $100, the total amount, which would give you 12.5% average portfolio return. Simple as that. And then we move on to variance. So you need to remember, if you've done basic statistics, that the variance is the variability in the data that we see, and the sum of variances is not just the variance of the sums, because we need to add a covariance term. Two variables might move together. So when we apply this to portfolio theory, this is the n asset portfolio formula. You don't need to remember this. This is just a notation. What you need to know is this one. This is fairly important when you're considering two assets. So the return of the portfolio, the standard deviation of the portfolio would be sigma square A for asset A, sigma square A into the weight assigned squared, plus same thing for B, plus 2 into WA, WB, sigma A, sigma B, multiply the correlation of A and B. And this, you take the square root of all that. It's fairly simple, just know this formula. And then we consider three different cases when correlation between the two assets is 1. So when correlation is 1, this term goes away almost. And then we get something like a square plus b square is equal to 2ab. So that becomes a plus b whole square, and then square and the root get cancelled out. So you just get the a and b. And here you're getting no diversification benefit. Your standard deviation for both assets is just the sum of their weighted sums. Now, when correlation is -1, what happens is that we get this minus over here instead of this plus. And in this case over here, what we get is a plus a square plus b square minus 2ab. So this can either be a minus b whole square or b minus a whole square. So we write this symbol. This symbolizes a minus b or b minus a. And here you get the maximum diversification benefit. This is the minimum possible uh, diversification, maximum possible diversification benefit that you get. In the third case, simple, nothing to see here. When correlation is 0, this entire term goes away. So you just have this term remaining over here. Now we build upon from this and try to construct a zero variance portfolio, which has zero variance. Absolutely. So in this case, the correlation must be -1 because they are getting the maximum diversification benefit. And the standard deviation of the portfolio has to be 0 to get a zero variance. So in the formula that we had derived here, over here, this one, if sigma p is 0, we get WA sigma A is equal to WB sigma B. And since there are only two assets, you're investing either in WA or WB. So WA plus WB is equal to 1, obviously. So we can write this instead of WB. And then we go through this calculation. You open this bracket up and then you take terms to the other side. You can see through it at your own time, at your own pace. And then finally we derive this, that the weight of asset A is equal to the inverse proportion of their standard deviations. And this gives us the zero variance portfolio. Now, there's something called a minimum variance portfolio as well, wherein we only consider the correlation to be 0. In such a case, when correlation is equal to 0, it's a difficult calculation. So you can just remember it's the same thing as above, just the terms are squared. All the terms are squared, and you always need to remember the difference that this is zero variance and this is minimum variance, because in the exam it happened with me as well. While I was taking a mock, the question asked for a minimum variance portfolio and I calculated a zero variance portfolio, and that was in the options, and I got that wrong. So you need to keep in mind that in minimum variance you square the standard deviations, you take the variances, and in zero variance you take the standard deviations as it is. Now, what we understand from this is that if there are two assets, A and B, which have different return and risk profiles, if you take a combination of these two, they having a correlation of 1, you will fall anywhere on this line when your weights are different. You can change your weights. You can, if you put 100% in A, you will be here. If you put 100% in B, you will be here. 50-50, you might be here. So this is when correlation is equal to 1. When correlation is equal to -1, like I said, we get either A minus B or B minus A. So then we have two lines, this line and this line, where correlation is equal to -1. And in this case, over here, you get your zero variance portfolio. Where do you get your minimum variance portfolio? Where correlation is equal to 0 here. And we usually try to lie on this line itself. We'll see how now. So now we move on to the formal modern portfolio theory. And this was developed by someone called Harry Markowitz. It's also called the Markowitz theory. And it has few assumptions, because without assumptions, the model would fail. So the first one is investors are risk averse and rational. What does risk averse mean? You understand that you take as less risk as possible. You don't take unnecessary risks. The second is that utility depends on mean and variance. That is, utility derived from an investment would be a function of three things. Firstly, the return. As return increases, utility increases. Secondly, would be the variance or standard deviation. So as this increases, your utility will decrease. And thirdly, risk averseness, which is already seen in this part. So there's nothing to see here. So therefore, we see it is called that risks and returns are normally distributed. We'll see that in the theory when we go through the notes. Third point is that there is a single period investment horizon only. You can't consider you invest now, take it out, invest now, take it out. That comes later. We'll study that in a different theory. The next one is efficient markets. That is, there are no transaction costs, no taxes. Short selling is allowed. Securities are divisible, like you can buy 0.01 of a security, which is not allowed in some countries in reality. And then last point, that is unlimited borrowing and lending at risk-free rate. RF is the risk-free rate. So what is risk-free rate? Risk-free rate is when you invest in a treasury security. Treasury securities means government securities. They are usually called risk-free because we assume that usually governments won't default on their obligations. So they are virtually risk-free. Now, risk averse would be that if someone takes more risk, they will want to earn a higher return, so their risk averseness. This is a risk averseness profile. And on the other hand, the opposite would be risk seeking, that a person wants to take more risk, and even if he gets a little lesser return, he doesn't mind. It's a little stupid, I know, I understand, but that's how it is. Now we move on to the actual part, the efficient frontier. So when we construct a portfolio, these points that you see here, you construct a plot of all the risk and return. uh, you take the risk and return of different investments and you plot them on this graph over here in different places. You plot them over here, right here. You plot them over here, right here. And then what you find is that what would be the most efficient investment among these? It would be the extreme left, because at this same level of return, you would want to take the least risk. You're getting the same level of return on this line. So you want to take this least risk over here, obviously. So this is the efficient frontier. This is called the efficient frontier. No, but that is not the case. Now you have to consider vertically as well. So now when you're taking this given level of risk, you can earn either this much return or you can earn this much return. So again, this part becomes useless. So this part only, this one in blue, is called the efficient frontier. And this point over here is the global minimum variance portfolio, because it has the lowest variance. And we've seen that thing over here. where correlation is 0. Now we move on to another second theory, and I mark this one over here because uh, now the important part begins, which is the capital allocation line. We see that even this efficient frontier is not efficient because there is a risk-free asset present. I take a combination of this risk-free asset and this asset A over here. If I take the combination of these two and anywhere on this line, let's say I invest 40% in RF and 60% in RA. So I can get return greater than the efficient frontier at a lower risk. That is possible now. So we say that the efficient frontier is not efficient. And why have I segregated into lending and borrowing? So this is called the capital allocation line because you allocate your capital in either RF or in this asset A. I'm sorry, you allocate your capital either in RF or in this asset A based on along this line which is tangential to the efficient frontier. Now this is divided into two parts because either, let's take this example. Let's say you invest either 40% in the RF and 60% in RA, and these are the returns. So net you get 2%, 6%, total of 8%. Okay, or you can borrow money at the risk-free rate from the market. So you take 50% from the market and you invest your total 100% plus this 50% in asset A, and what you get is a return of 12.5%. You get a leveraged return of 12.5% when you're lying over here. So now we see that the slope of this line would be RA minus RF divided by sigma A minus 0, from which we get the slope over here. And this is the so now from the slope we can derive the equation of this capital allocation line. This will give us that the return of the portfolio RP y is equal to RP is equal to M. M is the slope, so we have the slope over here. Slope into X, X is sigma P, so we have sigma P plus C is the intercept, and the intercept over here is RF. So this is the equation of the capital allocation line. Now moving to the capital asset pricing model. Sorry. So the capital asset pricing model is a development over the modern portfolio theory wherein all the assumptions are the same and we have two added assumptions. Homogeneous expectations. What this means is that everyone expects the same thing in respect to the movement of the stock price. So, so let's say I assume the same thing, you assume the same, everyone assumes homogeneous expectations. And the second one is that the actual return is equal to the expected return. We'll see how that works. So now, due to homogeneous expectations, everyone expects the same thing. So that asset A, we can write that as the market because everyone is expecting the same thing. So the capital allocation line becomes the capital market line. It's the same thing. It just the CAL becomes the CAML. You change A into M, A into M. The others are almost virtually the same. And this difference over here is called market risk premium, which will be mentioned in some questions later on. So keep that in mind as well. Now we're done with two things. Now we move on even further and we need to understand, like we had done in the first chapter in under types of risk. When we studied market risk, under that we studied equity price risk. They were of two types, systematic and unsystematic, that is general market risk and specific risk. So if it's a general market risk, you cannot diversify it away. What does diversification mean over here? Is that if you invest in, let's say, all auto companies, in that case, if one auto company is doing bad, you might be the other might be doing good, so your risk is diversified away in that aspect. But if the entire auto sector is doing bad, then your risk is not diversified away. So the entire sector doing bad is your systematic risk or non-diversifiable, and the other is unsystematic specific risk, which is diversifiable. So since investors are risk averse and markets are homogeneous, why should investors be awarded for risk that is diversifiable? So they are only awarded for risk that is non-diversifiable, which is called beta. Beta is the sensitivity of a stock price with respect to the market. Now, when we consider market risk over here, we will only consider beta, not the unsystematic or diversifiable part. And we have a ballpark figure of about 30 number of stocks. When your number of stocks reaches about, say, 30, we say that your unsystematic risk has been diversified away, and only your unsystematic part is remaining. And this is the formula for beta. It is the correlation into the ratio of the standard deviations. And you can work it around, and you can get it in terms of covariance as well. Covariance divided by the variance of the market. Now, how is beta actually derived? So you take the excess return on the stock and you take the excess return on the market and you plot it over here, and you get a fairly straight line, a regression line, which is called a characteristic line. Most stocks will lie along this line itself, a little bit up and down. And from this we can derive the equation of this characteristic line, which turns out to y is equal to m, which is the slope. The slope of this characteristic line is beta. M, x is your x-axis, and c is an alpha, which we'll study about later. Now the fourth one that we move to is again a continuation of the capital market line. So what we see is that now, since we are only to be rewarded for beta, that is the systematic risk, we take beta on the x-axis, and the beta of the market is 1. Obviously, because the sensitivity of the market to the market will be 1. So at this point, what we find is that we can draw something called a securities market line, the slope of which is obviously Rm minus Rf divided by 1. And any stock that lies over this is undervalued. Now you may be confused, if it is above this line, how is it undervalued? You need to understand that if a stock is undervalued and it is giving high returns, so if a stock is undervalued, this means its returns are very high, higher than what is expected. So it will obviously have returns higher than the market. So all stocks that lie above the securities market line are undervalued, and if it is undervalued, you're recommended to buy that stock. On the other hand, all stocks below, vice versa. It is fairly simple. Now there is also a horizontal classification for the same, uh, sideways, so to say, that all stocks with beta less than 1 are called defensive. For example, FMCG stocks, etc. And all stocks that have a higher sensitivity to the market are called aggressive. They have a beta more than 1, and they are usually, let's say, tech companies, but not very large. For example, if you say Apple, it will have a beta close to 1, because it makes up to over $2 trillion of the market. So that was almost the entire reading. Summed it up quickly, and let's sum it up quickly. The first one we saw was the capital allocation line, which we derived from the efficient frontier. This is the graph of the same, and it is used to compute the return of the portfolio. Its intercept is this. You can just read through it, keep this in mind, and I'll move to this application part now. So there are a few applications of all of this. The first is called Sharpe ratio. What Sharpe ratio gives is this. What is this top part? What is this top part? It is the return of the portfolio over and above the risk-free rate. Anyone can earn this risk-free rate. So what has been the manager's return? What return has he earned over that risk-free rate per unit of risk? This risk part is important because, recall again, in the first reading we had done a risk-adjusted rate of return. It is fairly similar to that. And again, this is higher the better, because it would mean either your RP is high or your sigma P is low. So higher the better. Next is a Trenner's measure. And what it does is replaces the sigma P with beta and only considers the systematic risk. Same thing, only considers systematic risk. Third is Jensen's alpha. So this alpha that I had told you that we had ignored for once in the characteristic line, basically what alpha is the capability of a manager. Alpha is used to judge the capability of a manager. and we'll read about it in the reading. Just know how to calculate it first. So we had derived the equation of this characteristic line. So if in the exam a question is given, you'll be given all the other figures and you just need to calculate alpha from there. Next, we move on to something called information ratio. With the theory of that we'll do over here. This is just the formula. It is the excess return over a benchmark divided by the excess risks over the benchmark. And lastly, we see something called Sortino ratio. So this is a modification of Sharpe ratio. What it does is that it takes the return of the portfolio over and above a minimum threshold level that is given. It is not always the risk-free rate because it has to depend on conditions of the market, and it does not consider the entire sigma p, it only considers sigma d downside deviation. Because why should the manager be penalized? Because this is the risk is basically a penalty since it is in the denominator. So why should he be penalized for high returns? He should only be penalized for very low returns. So that is why we only consider the sigma d. So now let's quickly see through the book. The first thing that we see is the assumptions of the modern portfolio theory. There are only three mentioned here. It's clumped together, but you should see what I've given. The second one, it says that investors are risk averse. They try to minimize the risk of their portfolios, obviously. Then the derivation of the efficient frontier is given through this plot over here. Nothing much to see over here. It just talks about correlation is equal to 1, 0, and -1, the three different cases that I have already told you. The efficient frontier is explained over here. It's called a portfolio possibilities curve because it has all the possible portfolios given over there. And just go through the theory once. There's nothing much to see. Even if you don't go through it, it's okay. But I recommend you go through it. Then we move to the capital market line. So, okay, over here they've directly taken the market. They've not done CAL and then CML, but the recommended strategy is to go through the steps one by one. The four steps that I've given: 1, 2, 3, 4. Nothing much to say here. Capital asset pricing model. So the assumptions are given is the same assumptions plus two more: the homogeneous expectations and unlimited borrowing and lending. And then they talk about systematic risks. So they talk about the derivation of beta, which is estimated through the regression of using the characteristic line. And then we derived the CAPM, which gives us the securities market line over here. And the beta of the market is 1, so you get all the figures required and you get an expected return, the final figure, which is equal to RF plus RM minus RF into beta. Yep, so this one is important, this part. They say that overvalued security would have a required rate of return that is higher than the expected return. So the CAP, since it is overvalued, the CAPM would value it above its expected return. So in that case, it would be plotting below the securities market line in reality. It won't be above. So just remember that it's opposite. Overvalued under the SML, undervalued over the SML. That was all in this reading. Just the performance evaluation measures. Go through it. The uses are given. Formula I've already shown you over here. Sharpe Performance Index, Trenum Performance Index, Jensen's Alpha. Okay, then there's something called tracking error. So if the manager is trying to earn a return higher than the market, then there will be some variability that he will face. So even if he's generating a higher return or higher alpha, there will be an error, and this tracking error is a useful measure in measuring the manager's performance. Then information ratio is equal to expected return above the benchmark divided by tracking error, and the tracking error is what I've shown you over here. This is a simplified version what I've done in the notes, and this is a more complicated version where you take the tracking error and do it. You should do it using the books method. And the last one, the Sortino ratio, where they take only the downside deviation and they take a threshold minimum rather than RF. That was all in this reading. Thank you.